Hello everybody, this is Brad Reed. I am a real-life trader and I'm here reminding you to be good. And by good, I mean get out of debt, achieve your financial dreams, give generously to your community, and do not talk into a microphone with a mute button pushed. It works much better if it's not on mute. I've just discovered that. Well, hello everyone. Thanks for watching this video. This is video number 2 of the Financial Fundamentals series. 3 concepts about money that you cannot live without. There's 3 concepts we're going to talk about: how debt is the opposite of wealth, the power of compound interest, and the destructive power of inflation. And in order to be successful with money, you need to understand and be able to use these concepts. So let's get started. First of all, going to address the lawyers. The topics and the education in this class is a broad format, talking about very generalized topics in general. I said general about 3 times there. And anyway, if you are seeking specific and individualized advice, you need to seek a competent professional in your area, because I am unable to customize this class for each and every individual that views the video. So if you are seeking individualized advice, find someone in your area. And let's get going again. These are the main takeaways for the overall series. Success equals opportunity plus preparedness. If you are not prepared, when the opportunity comes, you will not be able to be successful. And I think many people would argue that the opportunity of retirement comes once. You get one shot at retirement. So please, please, please be properly prepared. A big part of being prepared is to have a plan, and that's kind of what we're working on here. In a little bit, in a couple of weeks, we'll work on a plan for each paycheck. It's called a budget. And we'll also make a plan for retirement. Spend less than you earn. Much easier said than done. But if you want to gain assets, if you want to gain in your finances, you need to bring in more money than you put out. And then the last one, you are ready for retirement once your spending is less than the rate at which your money grows. Let's see if I can have my mouse here. Cool. So there's a couple of things here that if you are in retirement, you can control how much money you spend, right? You can control your expenses. If your money grows slowly, then you just need to spend less. Or perhaps you need to grow your money faster, and you can do that by hiring a competent financial advisor. We'll discuss that. Or you can learn how to do it yourself. And of course, if you go to reallifetrading.com, there are free videos on how to invest your own money, how to learn how to do it, and free trade setups and all that kind of good stuff, so that if you are in retirement and you need to grow your money faster, you can learn how to do it there. All right, so and here is the layout of the Financial Fundamental series. Right now we're over here in this preparation phase, okay? So this is getting ready to start the process. Then we have what I call the pregame, and then we're going to get out there and crush it and win. And then finally, once you have won with your money, how to lock in those victories, how to make sure that you will continue to achieve your financial dreams. And there's also part about in there about giving to others. The happiest people in the world give and help other people. One of the #1 ways to get out of depression is to go and to be outward focused and to help other people. So to be successful with your money, to be successful, I think, in life, a big part of it has to do with helping other people, and helping people that are, maybe in the situation that you're in, where you're in debt or you're not being successful and you don't know where you are and you need to get on the path to success. A little bit of hydration there. Remember, at reallifetrading.com, you can get stock reviews and trade setups for free. You can get free education. There are tons of articles and videos, and then some of the future videos I talked about in the last one. So let's move it on and get on going. All right, in this video, we will talk about key concept #1. Debt is the opposite of wealth. That may seem obvious, but there's a lot of people that confuse the two. #2, compound interest is the most powerful force in the universe, according to Albert Einstein. And #3, inflation is the most dangerous enemy that you do not understand. and then we'll finish up with some homework about updating your financial mission with your significant other. So several times I've had the opportunity to go in front of a live group of people and stand in front of them, and I always ask, why do you guys want to get out of debt? Why did you call me here? So start thinking about that in your mind. Why do you want to get out of debt? What's the whole point? And when I talk to people and I ask them this question, a lot of people will say, well, I need to get better rates on loans if I'm going to be financially successful. And other people say, so I can get a better rate on a car, or that I can get better credit cards. Some people have 0% interest on credit cards, and that's how to become financially successful. And what all of these people are telling me is basically that they want to get out of debt. They want to get their finances structured better so that they can get right back into debt, so that they can get even to more debt, and they can get back into debt even faster. And what we need to understand is that debt is the opposite of wealth. Being able to swipe your credit card, being able to get a loan for a car, a loan for a bed, a loan for a TV, a loan for whatever, that's going into debt. That's not getting better with your finances. That's getting worse with your finances. So if you take everything that you owe and everything that you have, and if those are the exact same amounts you have, the exact same amount as you owe, you have $0, you are broke, and as weird as it sounds, congratulations, because you are better off than about 50% of Americans. If you have more assets than you do debt, then you are wealthy, and if you can continue that trend, you are well on your way towards financial independence. However, if you go the other way, you are in debt, and I guess I changed this. I used to, instead of poor, I had you're royally hosed, because I used to be royally hosed because I thought by having a boat on a loan, a truck on a loan, a Corvette Z06 race car on a loan, a big screen TV on a loan, a bed on a loan, a couch on a loan, man, you name it. I had all kinds of stuff on different types of debt instruments. I thought I was living large. I thought I was wealthy. I had a car, I had a boat, I had great clothes, I had skydiving equipment, I had band equipment, I had all this kind of stuff. But holy smokes, I was beyond poor. I was royally hosed. So here is an example of why I think a lot of people confuse being wealthy and being in debt. The bottom line is, don't buy something unless you have cash for it. And I'll circle back around to that comment in a little bit. Let's say you have saved up $2,000 in cash, and you want to go buy a brand new car that costs $20,000. So you have $2,000. You're well on your way towards being wealthy, perhaps even financially independent, and you go buy a car. So the quick math, the unthorough math says, okay, I had $2,000. Now I have a $20,000 car, and I only owe $18,000. So all is good, all is happy. I'm well on my way. I'm leveraging my money. I'm maximizing my lifestyle. Everything is good. Everything is happy. I'm doing great with money and great with my life. But the problem is that car that you just bought is now only worth $17,000. And I don't know if you guys have seen that movie. I forget what it was. But this kid has just gotten a great new job and making a ton of money, goes into the Porsche dealership, buys a brand new, gorgeous Porsche, and as he is driving it off the lot, just enters the street and gets T-boned and totals the car. Well, most cars, the insurance value or wholesale value is much, much less. And so even though the car might be worth $17,000, if you resold it, insurance is only going to pay you $14,000. So you owe $18,000 on the car, but it's only worth somewhere between $14 and $17. Let's review. You saved $2,000, but now you're in debt $1,000 to $3,000. And apply this towards anything else that you take out a loan for. If you go and you buy a bed like I did on a loan, how much is a sleeped-in bed worth? Well, not very much. How much is a used TV worth? Not very much. What about dinner? If you pay for dinner with a credit card, you just essentially took out a loan for dinner. How much is that dinner worth that you just ate? So every time you go into debt on something and it decreases in value, And I'm going to argue that just about everything you can buy with the debt instrument decreases in value except maybe a house. All of this stuff is getting you more and more in debt, more and more towards being poor, and less, and further away, I should say, from financial independence. Now, here's a few more details. And I included some of these concepts in an article I wrote, Why the Rich Get Richer and There's Nothing We Can Do About It Except Join Them. So check this out. Really, that $18,000 that you owe on that new car it's actually going to be a little bit worse than that, because you have to pay interest, you have to pay taxes, there's finance charges, there's all kinds of hidden fees and application charges and whatnot. But I ran the math. If you have a 3% interest loan for 48 months and you pay 5% in taxes, you're going to end up paying, with all of the interest and the payments and the blah, 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 all of that's going to add up to $22,186.51 by the time you have that car paid off in 48 months. Now, the payment's going to boil down to about $420.55 per month. What if, instead of paying that to some bank that lets you borrow the car because they know that when you borrow the car, you're going to be in debt and you have no choice but to pay them back? What if instead you took that money and you put it into an account and you invested that account and you only got the stock market average, which is about 10% annually? So you don't have to be a stellar investor, just an average investor. Just get the stock market average. And instead of for 48 months, let's say you did it about 10% less for only 42 months, you would have $21,000. Now, if you do the math, the new car costs $20,000. You paid 5% in taxes. You can now buy that car at $21,000. But it only took you 42 months of saving instead of 48 months of paying it off. Oh, and by the way, you would have contributed $17,663.31 into that account. So if you took $420.55 and invested it 42 times, that adds up to this number, $17,600. So the point is, if you are a wealthy person, or if you're financially independent, you have cash on hand, you can put this money into an account and invest it. And by the time you buy the same car, you're effectively paying $17,600 for the same car that someone else pays $22,186, because the person over here on the left in green put this money into an account. Basically, they paid themselves. They put it into an investing account and grew the money themselves, whereas this person over here took out a loan for the car and paid someone else to get that money in advance. So people that take out loans are going to end up paying more for things. And in this case, the car, they paid about 20% more. They paid $22,000 for the car. Could have paid about $17,500 for the exact same car. This is why going into debt is the opposite of building wealth. If you build wealth, you can effectively pay less for the same things. Now, I have some friends that say, but Brad, what if you have a 0% interest credit card? What if you have a 0% interest loan on a car? Well, the math works out to be fairly similar. You buy the car, you buy the TV on the credit card, you buy the dinner, whatever it is now worth less than what you owe. When you buy anything, I don't care what the interest rate is on a credit card or loan instrument, you're going away from being wealthy. You're going away from financial independence. Folks, debt is the opposite of wealth. When you swipe the credit card, you are going away from being financial independent. When you take out a loan for anything, you are going away from being financially independent. Be sure that you save up in cash and only buy something if you have the cash flow. The one exception is a house, because a house is very, very likely to increase in value. It's very likely to increase in value faster than the debt is to grow on that house. And granted, that is the house that you live in. That does not include rental properties. Because if you have a rental property and you take out a loan for it, as soon as your tenant leaves, or you have 1 or 2 months of 1 or 2 months in that rental house and no rent coming in to pay for the mortgage, you end up upside down on it, and that's how foreclosures happen. So I have an expression that I like. It's called money doesn't grow on trees, money grows like trees. And if you think about the way a tree grows, it starts over here on the left as you got little tiny seeds and you plant the seeds and it takes forever for them to what is it, sprout? Well, the seed breaks open and the new tree comes out. And then a couple of years later, you have this little kind of scary twig going in your yard. And it looks kind of like, um, kind of like a weed. But if you give this tree several years to grow, it will eventually grow into this massive, beautiful tree. And your money is the same way. It grows very, very, very slowly at first, but if you leave it alone and allow it to grow, it will grow much, much faster as time goes on. So that's sort of the time value of money. If you let money grow, it will grow tremendously. Another way to look at it is to think about if you were a bird or something that ate sunflower seeds. If someone gave you a pack of sunflower seeds, and you ate the whole pack of sunflower seeds, well, you go on the next day and you're hungry. But what if you ate part of the pack of sunflower seeds and you planted the rest? Well, in a little bit, you're going to have a sunflower come up, and that sunflower may have 100 sunflower seeds in it, whereas one package only has about 30. So if you borrow those seeds, you can pay the lender back, and then you can eat the rest of the seeds. Or you can plant some of the seeds that you get, and then you can plant more seeds, and you can plant more seeds. As these sunflowers keep growing and producing more seeds, eventually you can have a whole crop of sunflower seeds, and eventually you get to a point where you're growing and making more sunflower seeds than you can ever possibly eat. That's called retirement. That's what you want to do with your money. You want to grow your money till it is growing so fast that your month to month and your year to year expenses are less than the rate at which your money is growing. Your month to month and your year to year expenses are less than your sunflower seed is growing. Or your month to month and your year to year expenses are less than your tree of financial success is growing. So this concept is called compound interest, and Albert Einstein says it's the most powerful force in the universe. Because if you can get this compound interest growing in your favor, your money can explode exponentially and just grow faster than you can ever fathom possible. This is, again, how the rich get richer, and there's nothing anyone can do about it but join them, because the rich have figured out that if they allow their money to grow and they spend their money, if they spend less than their money grows, they will always be rich. And if their expenses go up, if something happens, if taxes go into place or whatever, the society changes, they just lower their expenses. But the rich people are always going to allow their money to grow faster than they spend it. Now, the key here is that the longer your money grows, the faster it grows. So the law of 72 states that every 7 years, at 10% rate of return, your investment will double. So that means if in 2014 you had $100,000 and you didn't add anything to it, you didn't touch it, but you just invested it at a 10% per year rate of return, and I use that number because it's the stock market average, by the year 2021, 7 years later, that 100,000 will have doubled to 200,000. If you leave it alone for another 7 years, 200,000 grows to 400,000. 400,000 grows to 800,000 over the next 7 years, and 800,000 grows to 1.6 million over the next 7 years. So the cool thing is, if in 2014 you put $100,000 into an account and it grows at 10% year over year, and the year 2042, that $100,000 is going to grow into $1.6 million. Now, here's a problem, because most Americans get into debt straight out of college, just like I did, but instead of getting out of debt in their early 30s, most people get out of debt in their 50s. So let's say they invested $100,000 when they were 50 years old. When they're 57, they have $200,000. When they're 64, they have $400,000, and then they start looking towards retirement, and they have, I don't know, let's call it $500,000 to retire on. Well, not bad, but what if instead of getting out of debt at the age of 50, they got out of debt at the age of 43? Now when their retirement comes, they're looking at $800,000. Well, what if they got out of debt at age 36 and they invested $100,000? Now when age 64, 65 comes around, they've got 1.6 million. So the earlier you can get out of debt, the sooner you can start planting these seeds for your retirement, the more your retirement's going to be. And if you can think about it, this first 7 years, the money grows from $100,000 to $200,000. In that same amount of time, the money can grow from 800 to 1.6 million. Or let's say, like a buddy of mine, you got out of college debt free, you didn't go into debt, you immediately started saving money and investing money. By the time you retire, you have 3.2 million or 6.4 million. I had a buddy that he was age 35, and because he started saving immediately and he kept his expenses down, by the time he was 35, he could retire because his money was growing faster than he could spend it because he kept his expenses down and he grew his money faster. Now, another scary thing is if you are in debt and you owe money, and this kind of large glorified twig here is your retirement fund, the debt collectors are going to come and they're going to strip your tree. Let's say your tree provides firewood for heating, right? The goal is to get your tree growing so fast that you can cut off a branch here and there and fuel the fire to heat your house, and the tree grows faster then you can cut wood off of it for burning. But if a debt collector comes in, before your tree really gets going and they strip all these twigs off, your tree is going to start decreasing in size. And that's the case you want to avoid. All right, so another example, if you're age 22 and you put $5,000 into an account and you leave it alone, by the time you're age 64, that $5,000 will grow to $320,000 if you get 10%, which is the stock market average year after year. Now, put a zero on that. If a person age 22 puts $50,000 into account, by the time they get to 64, just that $50,000, they don't have to add any more to it. Just that $50,000 will become $3.2 million. Now, the reason I say 50,000 is that a lot of kids coming out of college, they have somewhere between $25,000 and $50,000 in debt, and they're facing 52% unemployment. So if you are a college kid, I would say stay away from debt because you cannot sell your college degree. I think it's better to take 6 or 8 years to get through college, but get out of college debt free than it is to come out of college facing 52% unemployment with 20 or 50 grand into debt. But if you did come out of college with 50 grand in debt and it grows, you can see how fast your debts are going to grow. The average age to pay off your college loan is 44. Now, granted, college loans don't usually grow at 10% rate of return, but the point of this is if you have debts, you need to pay them off quickly because these debts are going to grow instead of your retirement fund growing. Okay, and then lastly, because of this compound interest, I wrote an article called Everyone Should Retire a Millionaire. And if you go to reallifetrading.com and look under articles, you'll see it. But everyone should retire a millionaire because the mathematics are, this is math. This is not any kind of persuasion or magic or anything. This is straight up mathematics of compound interest. $4 per day at 10% rate of return or 10% return on interest. That's the stock market average. $4 per day at percent per year from age 22 to 65 is $1 million. So if you have $4 per day, you should become a millionaire. And when you think about it, how many of us have a $4 per day bad habit? Whether that's the gourmet coffee or the pack of cigarettes or 1 or 2 glasses of wine or beer or 2 at night. Guys, these $4 per day, if you invest it over time, can be $1 million. So next time you go get that gourmet cup of coffee, just think about it. That's $1 million cup of coffee. Because if you could put that money into a bank account every single day from age 22 to 65, you would have $1 million. And before I get off of this, here's one other concept for those of you that are financially successful or that are going to become financially successful. If you are going to give a gift to a charitable organization like Goodwill or Salvation Army, or maybe your alma mater, your college, what if instead of giving just a lump sum cash gift that is likely going to be spent very quickly, what if you put that money into an account with a financial advisor and you told the financial advisor, hey, allow this money to grow according to inflation, but anything beyond inflation, give it to this organization over here. So what I'm saying is let the money grow and give to the organization the growth of the money less an inflation factor. And that way, instead of giving a one-time gift that's going to be spent and gone, and maybe you get your name on a brick on a wall somewhere, there's a giving that happens every single year or every single month forever, because you are essentially creating a money tree, a compound interest growing tree for your charitable contribution for your organization of choice. For me, this is the better way to give, because it's a gift that gives every single year for the rest of your life, for the rest of the organization's life. So just an idea. If you have any questions about that, give me a call or send me an email, brad@reallifetrading.com. Cool. So here are two pictures that I found. The one on the left is very clearly the cost of living in 1970. The one on the right is a McDonald's menu, and I don't know what year it's from, but I'm guessing it's about the same time period. And as you guys are looking at the numbers there, you'll notice that they're much less than they are now. I remember when I was about 7 years old, my dad would take me to 2J's restaurant in Austin, Texas. It's pretty close to 38th Street in Lamar. It was my favorite hamburger place, and my cheeseburger, fries, and a soda all cost about $2.15. Let's see, I was 7 years old in 1981. So $2, and we'll put it right in the middle. Well, I was going to say, over the years it grew up to about $2.75. But if in the 80s a cheeseburger, fries, and a soda cost $2.50, why in the heck does it cost $6 or $7 today? How come in the 1970 a new car cost about $3,500, and today it costs anywhere from 20 to 30 grand? Why did a movie ticket in the 1970s cost $1.55, and today a movie ticket is anywhere from $7 to $10? How come all these prices are going up so crazy fast? Well, I'm sure a lot of you guys are saying, hey, Brad, that's inflation. Oh, I didn't finish my cheeseburger story. My dad said that when he was in high school, a cheeseburger and soda and all that cost about 40 cents. Excuse me. So 40 cents when my dad was in high school, $2.50 when I was about 7 years old, $7, $6 or $7 today, and I'm 41 years old. Then the question becomes, man, what's it going to be by the time I retire? And an even better question, how much is a cheeseburger, fries, and a soda going to cost at the end of my retirement? So here's the deal. If this picture on the left was the cost of living in 1970, those people that retired in 1970 or 1980, how are they feeling about the cost of living today? So all of this cost of living increase, when it's measured, is called inflation. Inflation is the most dangerous thing you don't understand, because the price of living goes up just about every single year. Now, the magic number for many, many years has been 4%. That the price of, the rate at which our cost of living increases has averaged about 4%. Now, there's going to be a few financial people out there that say, hey, Brad, the mathematical average, if you date back to such and such year, is 3% or 3.2%, and that is true. But do you feel that the last 8 or 10 years have been a representative rate of inflation? And the answer should be a definitive no. I feel very, very strongly that when you do your mathematical calculations, you should use 4% for the average annual inflation, because that's been a much more reliable number. It's also a more conservative number. Moving on. So here it is. Inflation means the price of things we buy go up every year. Cheeseburgers, clothes, cars, taxis, rental cars, housing, whatever you might possibly spend your money on, the price goes up just about every year, and it goes up by just about 4%. At 4% inflation, prices double every 18 years. The average retirement period, folks, is 30 years. That's average. Average retirement is 30 years. Prices are going to triple during your retirement. Okay? Now, if you're 40 years old like I am, I'm expecting to retire in about 30 years, and I'm expecting to finish my retirement in about 60 years. So I need to plan on prices tripling twice. So basically what that means is A cheeseburger about the time I go to retire is going to cost about 20 bucks. And at the end of my retirement, when I'm taking my grandkids to go get a cheeseburger, one cheeseburger is going to cost about $60 or $70 in 50 or 60 years. I know that sounds ridiculous, a cheeseburger costing $50 or $60, but think about when my dad was in high school and a cheeseburger and a soda cost 40 cents. He probably never fathomed that a cheeseburger was going to cost $7. So guys, when you're planning for your future, you need to plan for expenses at the end of your retirement. Here's another scary fact that has to do with inflation. College costs are going up faster than inflation. College costs have been going up faster than inflation, almost double the rate of inflation for about 25 years. I have a 5-year-old and a 2-year-old, and the scary thing is my children are looking about $250,000 each for a public in-state college 4-year degree, living on campus, but books, food, room, and board, all that kind of stuff, all combined at a public in-state school, 4-year degree, $250,000. So understand inflation is basically compound interest going against you. You need to plan for these expenses in the future. Okay, so a quick review. Getting out of debt is good because every time you go into debt, you make it harder and harder and harder to get towards financial independence, to get towards being wealthy, to get towards being rich. Invest as much as you can, as often as you can, because you want that patch of sunflower seeds to grow as rapidly as you can. You want that retirement tree to grow as fast as it can. You know, a lot of people have a number or an age, they have an age or a year in mind for their retirement. Guys, retirement is when your money grows faster than you spend it. If you can keep your expenses super duper low and you can grow your money super duper fast, you don't need a huge nest egg savings to retire. You might be able to retire today. So keep that that math in mind, that if your money can grow faster than you can spend it, that is retirement. And then to make that retirement calculation even better, let's throw an inflation factor in there. Okay, so we want your money to outpace inflation, because inflation will do this to your retirement tree. It'll take your tree and it'll turn it into a seed faster than you can fathom, because in 30 years, prices are going to triple. True story, I hear financial advisors all the time on the radio. They talk about, hey, if you invest in this, we can give you $50,000 a year for the rest of your life. And holy smokes, $50,000 a year for the rest of my life, that sounds pretty ridiculously awesome. But the problem is, in 30 years, that $50,000, that won't be enough to live off of, because you know the average income today is about $51,000. In 30 years, the average income is going to be $150,000. And what $50,000 buys today, you know, that lifestyle is going to basically be cut by a third. So if you are interested in investments that pay out year after year after year, please, 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 please consider inflation, and consider what inflation is going to do to the buying power of that number in the years to come. Okay, it's absolutely crucial you understand these concepts. Please review the video, review the concepts, look them up on other resources. But if you are going to be successful with money, you must absolutely be able to understand these concepts completely. Okay, so once again, the takeaways from the whole series are: success equals opportunity plus preparedness. Be prepared. If you want to be able to capture and be successful when the opportunities come, you've got to be out of debt. When that retirement opportunity comes, you have to be prepared because you've taken advantage of compound interest. You have to be prepared to tackle inflation. So have a plan. Okay, have a plan for each paycheck. That's called a budget. And have a retirement plan. Spend less than you earn. If you spend less than you earn, then you can put extra money into your retirement savings, and you can get that tree growing even faster. You can get that crop of sunflower seeds growing even faster. And here's the last one: retirement equals spending less than your money grows, including inflation. Oh, and by the way, you guys do know that I'm going to give you a calculator that's going to be able to calculate how much you will need for retirement and how much your money will need to grow, what rate of return you're going to need. It's coming, guys. I have it built. It's actually at reallifetrading.com. If you want to go to reallifetrading.com/retirement-calculator, it's there. You put in the numbers, you put in how much you want if you were to retire today and how many years you're going to retire. It applies the inflation factor to how much money you're going to need at the end of your retirement. It tells you how much money you're going to need at the beginning of your retirement, and it'll tell you what rate of return you're going to need to get between now and when you retire, or if you are already retired, what rate of retirement you need during retirement. It's already built. It's coming. Hang with me. Watch the future of these financial series, and it's coming. It's already out there. Okay, but before we get to reallifetrading.com/retirement-calculator, do this with your partner and do it on paper. First of all, write out on your financial mission. Describe our current situations and emotions. This is very important for you to document what you're going through right now. Things like, I don't know where the money went. We have too many bills and not enough paycheck. I'm afraid to tell the wife and her kids that we can't afford it. I make too much money to be this darn broke. These are all the things that went through my mind. Other people that I've helped, they tell me these things. What is your current situation like? Write it out. And the reason is because when you get halfway down the road and you start seeing that light at the end of the tunnel is not a train coming towards you, you don't want to slip back into your old habits. So write out what it feels like where you are now. Document that. And whenever you feel like compromising one of your principles that you're going to create in the next couple of weeks, I want you to come back and read your financial mission statement and see where you were, and that'll be fuel for the fire to not get back ever into the situation that you're in now. So describe, write it out. Write out all your fears, write out your emotions, write out your questions, write out your doubts, how you're afraid of retirement, you're afraid of the future because you don't understand how the math works. And then trust, as we go through this financial fundamental series, we will answer all of those questions and we will lay out a roadmap where you can get through the tunnel and it's bright and sunny and green and grassy on the other side. Number 2, what are you willing to do to change the current situation? We're willing to sell the skydiving rig that's in the basement that's been in there for 7 years. Guess who sold their skydiving rig a couple of months ago? We're going to stop going to eat sushi every Thursday. Guess what my wife and I stopped doing when we realized what that sushi meal, the impact of spending that money on sushi every week, when we understood with compound interest how that would affect our retirement. Much more conservative, much smarter with money these days. Also, what are you going to start doing? My wife and I started doing a budget when we went through all of this, all of these numbers and all of this understanding. And we stick to that budget and we don't spend what we don't have. So talk about, what are you willing to do? What are you willing to give up? What are you going to sell? What are you going to stop doing? And what are you going to start doing in order to be successful with your money? Then number 3, describe what financial success feels like and how are you going to know when you get there. And the reason for this is, as I've talked to people and I've heard people talk, that they get in this saving mode and all they do is they save. And eventually someone says, hey, we're going on this vacation and it costs $5,000. You should come with us. And they're like, $5,000 for a vacation? Forget that. And then you find out that they've got $4 or $5 million in the bank. And it's like, it's okay to reward yourself when you have completed all the steps and you're financially successful. So be sure you describe what financial success will feel like. And, I don't know, it might be good to put in there, even no matter how financially successful we will be, we will never spend more than our money grows after an inflation factor. That's kind of important. And then write down what are the steps to achieving your success. And as we go through the financial fundamental series, we will document those steps one by one. We will talk about how to do them, and we will develop your skill on how to handle money. It's coming, guys. But do this on paper. Do this with your partner, with your spouse, with your significant other, with your mentor, with your whomever, but do this with another person. Uh, you've absolutely got to do this as a team. If you are married, there is no way you can be financially successful unless you have your spouse, your partner, your significant other on board with you. Okay. The goals for today were to understand the three concepts that debt is the opposite of wealth. Money and debt grows like trees. That's called compound interest. Inflation is unimaginably dangerous. You must get ahead and stay ahead of inflation. Grow your money, grow your income if you can, faster than inflation, and be sure you spend less than your money grows after inflation. All right, update your financial mission. And if you have any questions, email me, brad@reallifetrading.com. Guys, thanks for watching this video. I appreciate the opportunity to do this. So thank you guys again. And trade on logic, not on hope. Have a good one, everybody.